go-to people for advice and planning and answers. So we've invited them to come and visit with us today and maybe kind of uncover some of the mystery around all these different taxes and what are the taxes on and what's exempt and that sort of thing. So without any further ado, I'll introduce Steve Hammock and let him start the presentation.
Good afternoon. As Skyler said, I'm Steve Hammock. I'm the managing partner of Hammock, Lewis, Hammock, and Sturwald. Erica is one of our CPAs that lives just up the road in Bowling Green. So, as Skyler said, our practice is primarily a tax practice. We still do a lot of write-up work, help companies with their books. Erica's an absolute expert in QuickBooks, so if anybody ever runs into issues in that, she's the one to contact. So anyway, as Skyler said, there's tons of new taxes, over 20 new taxes in the Affordable Health Care Act. So I'm going to try to hit some highlights. Got sort of some repetitive examples, and I think if I just speed through there to not keep you here all the full hour. And but if you got any questions, ask them anytime. And this, you know, particularly last several elections, national elections, you hear about Florida's the big swing state. Whoever wins Florida is going to win the national election, and the I-4 corridor is so important. But we miss hearing about that because we're working on the 98 and a little detour off the 17 corridor, because we have an office in Dade City, Lakeland, and now down with Erica and Wachula. So again, over 20 new taxes. I'm just going to show you some comparison of the rates from 2012 to 2013 to show you where these changes were and why these taxes were higher this year. You notice all the rates are the same until we get down here. And then it jumps to 39.6%. I'll show you where that falls in. We hear a lot about rates on capital gains and qualified dividends jumping from 15 to 20%. And again, depending on your taxable income, depends on when that extra 5% would kick in. And the estate tax rates jump 5%. And sometimes you think, oh, that's not a big chunk, but we're finishing a taxable estate. Probably a couple months before it's finished, but it's about $4 million of that estate's going to be taxable. Another 5%, that's another $200,000. So, you know, it adds up to real dollars. So here's the change right here. For that 39.6% on a joint return jumps in at taxable income over $450,000, single $400,000, and then married filing separate head of household. You get an idea where it comes from. Same thing with these capital gains. So if you are in some of these, if your taxable income is not exceeding actually $450,000, you're still getting those dividends taxed at 15%. So some people automatically think, oh, I'll pay an extra 20, but in reality, you're not unless you're over that 450. This is not actually part of Obamacare, but the phase-outs are back, and this has impacted a lot of people. Phase-outs of personal exemptions, phase-outs of itemized deductions. The beginning in 2013, you lose 2% of your itemized or your personal exemptions for every $2,500 over these amounts. So you completely lose your personal exemptions, all of them, at $422,500 if you're filing a joint return. And I'll convert that to dollars for you in just a minute, and you can see the impact. And this, as I said, can be completely phased out. And at these different levels, at these different filings, statuses is where they can completely phase out. That's 100%. Anything over these amounts, you start losing deductions. Same thing with itemized deductions. You can lose 3% of your itemized deductions in excess of adjusted gross income or these thresholds. At $300,000 on the joint return, I keep referring to joint returns. They don't get completely phased out, but you can lose up to 80% of them. I filed a tax return this year. Go ahead. Oh. little over $80,000 in itemized deductions. You got to write off about 20 of them. So there's 60 grand just lost. So, but there are some ways to try to minimize it now. Now, this phase out does not apply to medical expenses, investment interest, casualty, or gambling losses. But it does apply to your home mortgage and your real estate taxes and your charitable contributions. And we're starting to see in the charitable arena, people aren't giving quite as much money anymore because they're not getting that same deduction.
That's being in the citrus business, casualty and gambling.
Yeah.
Yeah, we gamble every day.
So, determine the phase outs. Okay, assume the married couple has adjusted gross income of $670,000, 2013 applicable amounts $300. That's from the slide before this, built into the code. So, and they have $45,000 in itemized deductions. Based on this, what they're going to do is they're going to lose $11,100 in itemized deductions. Because you take the adjusted gross income, 670, reduce it by the 300 applicable amount, that's 370 times 3%, $11,100. So that's specific. That's not dollars that you're losing, but that's a deduction that you're losing. And the other is you can't lose more than 80% of the 45, that's 36, so you take the lesser of the two. So these by the way, these phase outs, that came from the 1990s is where that first came from. There was a Democratic congressman from Ohio named Donald Peace that put this legislation in place, and when George W. Bush was president, we gradually phased this out, but the end of 2012, they let the phase out expire, and so that's why they're back now. Here's 3 examples of tax returns that our office actually filed. And not everybody we file is this kind of income. And I'm sure you're going to feel real bad of a tax increase for somebody that's making this kind of money, but as an example though, these are 3 different taxable incomes for taxpayers. That's what their tax was when we filed the returns. On the $1,700,622. Applied the 2013 law to the exact same income, the exact same deductions. Increase of $105,552 at the stroke of midnight on December 31st, 2012. Same thing. So what I want to do is try to get a middle ground because not everybody makes this. But here's somebody a little bit higher. Again, same exact income, same exact deductions, $55,000 additional dollars in taxes. If you're not expecting that, that's a big change. Particularly, not all the income's W-2 income, so you had to get estimated payments paid in, this type of stuff to cover this. And then here's another one at 362, and his taxes still at $14,000. It's significant. I just wanted to give you an idea of the difference of the impact that this law has actually had. Okay. As I said, these fees limitations, it's not many ways to avoid them. So what can we do? Is we try to lower above the line income through contributions like to a retirement plan. Put more money into your 401k plans. Put more money into your profit sharing plans. These type of things. Put deferred income away. And that's kind of stuff that Connolly's office can help you with. Refinance or pay off your mortgages. That might be a little contrary to what an investment advisor would want to say, because they want to invest your money and get you a better return if you got a home mortgage where you're only paying 3% or something. But the reality of it is there's a good chance you're losing the deductibility of that interest anyway. And then, of course, we do tax projections for people. A lot of my clients, many of them were very well aware of what was going to hit them long before we ever filed a tax return.
Yeah. So let me add a couple things. So look, if you're going to be buying new equipment, chemicals, considering some kind of building addition, it's very, very, very helpful to get Eric and Steve to help you do multiple projections to figure out, should I do it this year, should I put it off to next year? So really take advantage of this. The second thing I'll tell you is that in our lifetime, I don't think you'll ever see mortgage rates these low again. Okay, so I remember when I bought my first home with my wife and I, 30-something years ago, I mean, the rates were 14, 15%.
I was happy to get it.
So we have conventional mortgages at UBS, the plain vanilla 15 to 30-year mortgages through Fannie Mae or Freddie Mac, but we also have a lot of variable type mortgages where you can lock in interest only for 2, 5, 7, 10 years. I'm only going to be in my house, good Lord willing, another 7 years, so I locked in like 2.7 for the next 10 years on my rate. So this is a really key thing. So we're all busy, but take the time to see if it makes sense for you to refinance your mortgage. If you lower your rate from 6 down to 4, I mean, it's still that's a 50% savings. And the last thing I'll tell you is they've really done a good job of increasing the limits or the amounts that you can contribute to your IRA account or some type of simple IRA or SEP IRA or something. So this is something that we see really adds success to planning for retirement down the road. And it also saves you taxes today.
And one thing Conley mentioned too, we talked about maybe equipment and such that you're buying. I don't know if you're familiar with Code Section 179, but that code section allowed you to expense your equipment purchases in the last several years up to $500,000 a year. So you still had to capitalize them, but you were able to expense them, and you did not have to depreciate them over 5 years or 7 years, sometimes over 15 years. Yesterday, there's a Senate bill that looks like it's going to get approved. But let me back up. Part of the new legislation this year, the Section 179 election is dropped from $500,000 to $25,000. That's all you can expense this year. But yesterday, there was a Senate bill that hit the floor to increase those rates back from $25,000 back to $500,000. So, I mean, that's absolutely huge if that ends up getting passed. Although it ain't going to pass in Washington. Doesn't seem easy to do these days. Okay, throwing this in here just to make you aware of it. Higher thresholds for Medicare. This is part of Obamacare. Medical expenses, pretty tough to write off anyway. They're itemized deductions. Only the excess over 7.5% of your adjusted gross income is deductible. So if you had $100,000 adjusted gross income, 7.5% of that's $7,500. If your medical expenses do not exceed $7,500, you're not writing off any of them. So what do? Look to health savings accounts, which you get a deduction for. Put money into your own health savings account. If you qualify, you're going to have a high deductible health plan to have one. But it's like an IRA for medical expenses. And as long as you use that money for medical expenses, all their earnings are tax-free. And so what you've done is you've taken an after-tax deduction and made it a pre-tax deduction. So they're huge. If your employers offer FSA accounts, flexible spending accounts, put money into those accounts. You could put a lot more money into them in the past. Part of Obamacare had lowered the limits of what an employee can put into an FSA to $2,500. But still, it's pre-tax money. You don't pay tax on it. So if you have the available cash flow, you should do this. I'll give you an example of what this means as far as trying to bundle expenses into 1 year. And we'll use medical as an example because it's got that 7.5%, now 10% limitation on adjusted gross income. So let's assume your adjusted gross income is $70,000. 2013, you have $12,000 of uninsured medical expenses from elective surgery, colonoscopy, glasses, contact lenses, and some dental work. Next year, you only have $2,000. On your 2013 return, you can claim a medical expense deduction for $5,000, which is the $12,000 that you spent minus 10% of your adjusted gross income of $7,000. So you got a $5,000 write-off. Next year, you won't have any because assuming the same income, the 2,000 that you spent in the subsequent year does not exceed the 7, so you lose it. Point being that if you had spread the same amount, the same $14,000 over 2 years equally, you spent 7 in one year and 7 in the next year, you had no deduction at all because of the 10% limitation that you have to exceed on just the gross income. So if you can bunch expenses, if you know kids are going to have braces and these type things, try to concentrate and bunch those expenses into 1 year. You can also do that with your real estate taxes. Your prior year's real estate taxes you can pay in January, and your current year real estate taxes pay in November or December, and you got 2 years taxes in 1 year. So if you're marginal or borderline, whether you itemize year to year, things like that will help put you over the top. And you at least get some tax savings out of doing it that way. Okay, I mentioned the FSAs. If your employers offer these, absolutely take advantage of it. Again, that's the lower limits of $2,500, but still depending, that's $2,500 times whatever your tax bracket is, you save that money. So, I mean, if you're right at 28%, it saves you a little over $700 in taxes.
So even if you're in a 40% tax bracket, in other words, basically you're saving the income off of roughly $4,000 or $4,500.
Yeah, at 40%, it saves you $1,000.
And you do that with your spouse, I mean, you're talking, it all really adds up. And I think one of the things that we've learned with all these different changes is that, if you kind of bundle everything together, you can really pile up the amount of savings and taxes you can
That's
save.
the key. That's what part of our strategy has come down to, is trying to bunch where you can. Okay, a little bit about FSAs. I don't know, does anybody have an FSA? All right, talk to your employers, but they are simple to install. A lot of the insurance companies will do them for you. You can go to the banks and get them set up. I don't think there's any annual reporting on those. So, I mean, very easy administratively. They don't cost hardly anything to operate. So I won't spend any time on this. It used to be you could get OTC drugs and use your FSA account. Now, if you're OTC, you need a prescription for the doctor. So, and again, anybody have a health savings account? Those you can do on your own, again, if you have a high deductible medical insurance plan, but that's easy money. You can put $6,450 each year right now into the HSA, and it's a deductible expense comes right off the top of your income.
Yeah, Barbara, maybe what we can do is get some information to disseminate amongst the members because, like she said, it costs next to nothing to have these things, and everybody can have one. You don't have to be part of your employer or your company or that sort of thing. So we'll get you some information on that.
Great.
What can that SAA be used for, and what can it not be used for?
The HSA, health expenses. So going to the doctor, prescriptions, all that type of stuff. Any health-related expenses that can be used for that.
Glasses and
Glasses.
Is it just on you, or can you use it for the family?
your family.
That $6,450 is for family. They have lower limits if you're single.
Yeah, Rowdy, it's not a real narrow window of what you can use for. I mean, anything health-related, going to the doctor, prescription, the deductible, I mean, you name it. I mean, it's very much, it's easy and flexible.
And what happens, let's say you put $6,450 in and everybody's healthy that year, you don't spend it. Well, it's in some type of interest-bearing account or invested through UBS or whatever, it's growing. You put $6,450 the next year, the next year, and the next year. Use it when you need it, but it continues to grow tax-free. And as long as it's used for health expenses, it's never taxable to you.
I think that's a key point. You never lose it. So, you put it away for 3 or 4 years, then you have something major coming up, or as we get older, we need colonoscopies or whatever type of exams. It's there, and you don't lose it if you don't use it. So I think that's a good point.
Which is different than the FSAs through your employers, which nobody has, but if you do, FSAs, you do have to use that money. So you put in your $2,500, in your mind, you gotta think, oh, I know I've got a crown this year that I'm gonna have to get, or the kids need, extra glasses or dental work or braces or whatever.
If money's taken out of there and used for some other purpose, are we penalized in some fashion?
Absolutely. Let's go back right here. Beginning in 2013, this was again part of Obamacare. If it's used for another purpose, you pay tax on it, but then they hit you with 20% excise tax as well. So whatever tax bracket you happen to be in, you pay tax on what you take out. Let's say you're in 15% bracket and you take out $10,000 out of your account. It's going to cost you $1,500 for the tax, and then it's going to cost you another $2,000 of excise tax. They don't want you, they give you a great benefit to put it there and save that money for your health expenses in the future, but they penalize you if you take it out for other purposes. Same thing like with an IRA, basically, if you take it out. Here's the tax, 0.9% Medicare tax, part of Obamacare. It increases right now on your wages, or on your earned income, you pay 1.45% on your wages, Medicare tax. It's going to increase to 2.35%, but it only applies at $250,000 for a joint return and $200,000 for a single return. And I'll give you an example here how that works. Does not affect the employer. So if you have an employer that, or an employee that's making over $200,000, the employer does not have to match it, which they do on the 1.45 they have to match, but they don't have to match 6.9%. Same thing on Social Security, where the employer matches your Social Security tax that you pay. All right, I don't want to get too technical on what this is, but so let me just give you an example. Harry and Sherry, married couple, make 125 and 175 respectively. First, which is total of 300. First 250 combined wages taxed at 1.45%, for a total of 36.25. This is getting withheld from your paycheck. So it's like money you never see, but it's a tax that you are paying. The next 50,000, that's the combined 300 less the 250, is taxed at the higher rate, 2.35%. Combined tax is 4,800. The new additional tax amounts to an extra $450. Here, the employer is not required to withhold the additional $450,000. The employer only has to start withholding if the wage hits over $200,000. So, just another example here, and I'll speed this along there rather than go through each one of those, unless anybody is interested. So again, employers not required to withhold the additional Medicare tax until you reach that pay period that the employee goes over $200,000. So if the, let's say you have an employee that makes $210,000, I withhold that tax as an employer on the $10,000, that $10,000 over the $200,000. But he's not subject to the tax if he's filing a joint return. Let's say his spouse doesn't work, but the tax got withheld. You have to recover it when you file your tax return. The tax will, all these taxes are calculated on your 1040. You can't ask your employee not to pay it or not to withhold it. You can only recover the credit by claiming it on your tax return. If you are subject to it, and you want your employer to withhold more, you can't do that either, which is odd that the government would not take more money. It's one of the, that may be the only time we ever think that the government won't take money from it. So if you do need to get extra money paid in, you change it up before and have more income tax withheld. Here's another new one. This hit a lot of people this year. This is 3.8% additional Medicare tax. This is referred to as the net investment income tax. It is subject, it's a tax on it's a tax on non-earned income, essentially. interest, dividends, royalties, rents, capital gains, passive income from a trader business. You've invested in a business, but you're not involved in it, you're not working in it. Those type of things are subject to this new tax. What's excluded? Wages, your things that you work for, your self-employment, unemployment's not. Interest on tax exempt bonds, and you mentioned, I'll get Conley to mention something about that in just a minute. Social Security, alimony, these type of things are not subject to it. And it is in addition to that 0.9% Medicare tax as well. So,
Steve, back up 1 second. So one of the things that Eric and I are trying to do is, a lot of our folks have different buckets. Maybe some is a tax preferred bucket, like a retirement account or a profit sharing account or something like that. And then you have maybe an individual or joint account. So what we're doing with our folks is sitting down and seeing if we can shift maybe some of the taxable things, like the dividends or the taxable interest, to an account where maybe we can avoid that tax. And one of the key things here is that interest on tax exempt bonds, those are municipal bonds or tax-free bonds, those are not affected by this tax at all. So a lot of times what we've been able to do is shift our clients' income from taxable bonds, like CDs and things like that, over to tax exempt, and actually come out ahead because you're actually right now getting a higher rate of return on tax-frees than you will on taxable bonds. So we're not going to say one size fits all, but what we're doing with our folks is sitting down and looking at, okay, how can we maybe reposition things a little bit to avoid these, that's an almost 4% tax. So we'd encourage you, that's a very, very important part of planning.
So when you get to this 3.8%, and depending on what tax bracket you fall in, your capital gains that were max rates in 2012 and before were 15%, can now actually be 8.8% higher, because now you're paying at 20% versus 15, and you're paying this 3.8% on top of it. So big change.
Which really is a 50% increase, because now instead of it being 15, it's 23.8. That's literally a 50% increase in the tax.
It's huge, and it's really affected a lot of people this year. Okay, and this is just what should be exempt. If you're active in your business, as income or partnerships, not going to be subject to it. Covenants not to compete, not subject to it. And again, as long as you're active and it's not a guaranteed payment, not subject to it. Okay. A little bit more, what's not subject, unearned income. Your IRA payments, your Roth IRA payments, if you're getting pension distributions, this type of stuff, not going to be subject to this new tax. Okay, let's see. Okay, how it's calculated. It's 3.8%. It's on the lesser net investment income or the excess of modified adjusted gross income over the threshold amount. And the threshold amount is 250 for joint return. I'll just show you on the 200. Again, here's the things that are subject. Gains from sales of stocks, mutual funds, real estate, these type of things. I'm happy to slow down and go through this, but I know you guys are probably in a little bit of a hurry. This may not be the most exciting subject for you guys. Can actually be subject to a gain on your house if you have a sale over the limitation amounts on the house, on the exclusion amounts on the house, I should say. All right, so let's just as an example. Kayla, single taxpayer, has net investment income of 100 grand, modified adjusted gross income of 220. Taxes is imposed on the lesser the net investment income, which is 100, or modified adjusted gross income over 200, because that's the base amount. 220 less 200 is 20, so the surtax is $760. All right, assuming the same in the previous example that the modified adjusted gross income instead of being 220 is 300. So 300 less the 200 base amount is 100. 3.8% is $3,800 additional tax. So doesn't affect everybody. Yeah, Robert.
What,
put it into like an S corporation, you rest just comes through as ordinary income, not subject to self-employment tax, which can be huge.
Good
So
point.
there are some opportunities there. Again, this is just what Conlon was talking about, invest in municipals, put more money in retirement plans, maybe grow stocks instead of dividend paying stocks, that type of stuff. Okay, we'll jump off tax, let's talk about patient protection and Affordable Care Act. This is, was actually passed in 2010. Among other things, it is designed to simplify the process of obtaining health insurance, particularly for individuals and small businesses. So, if everybody watches the news, how well do you think that's worked out? As far as simplifying the process. And they're touting the fact that 8 million people have signed up. So there's 316 million people in the U.S., so that's a little over 2%. So I don't know how it's a rating success, right? So, Patient Protection and Affordable Care Act. Is it the same as Obamacare? Yeah. Yeah, just that's the formal name, but it's what's referred to as Obamacare or the ACA. So if you hear all those acronyms and such are all interchangeable. Most fundamental aspect is the employer shared responsibility, also termed as employer mandate or the pay or play mandate. So if you don't participate, you pay penalties. Okay, what does it entail? Simplest terms, effective January 1st, 2015, and they've already pushed us back 1 year to 2015. An applicable large employer must offer full-time employees and their eligible dependents coverage. And it's got to be affordable, and it's got to provide a minimum value, or you face a penalty.
What's the definition of affordable?
That's a very good question. Affordable is the employee's premium cannot exceed 9.5% of their household income. So you're employing somebody, but they've got a husband that works. How do you know what their household income is? You don't.
Well,
So
what do you do with piece rate workers? Because you don't know what their household income is going to be.
That's exactly right. So they built in some safe harbors, and so as long as it doesn't exceed 9.5% of what you pay that person, your employee, then that's a safe harbor. So if you paid somebody $20,000 a year, roughly 9.5% is about $1,800, $1,900. As long as their premium doesn't exceed that $1,900, you fall into the safe harbor.
But it's going to be interesting to see what happens. I don't know if any of y'all saw all the insurance executives in front of Congress yesterday, right? And they asked them to raise their hand if you saw premiums going down by a significant extent. And so they're going to have to adjust this because clearly the cost of insurance is going to go up, not down. So it's going to be interesting to see how that patches. Steve, doesn't this apply to only if you? How does the number of employees that you have? How's that?
I'm going to show you. That's a good question. Glad you asked.
What's the larger employee, 20 or more?
It's 50 or more.
50 or more.
Yeah, I'll show you. So, large employer with at least 50 full-time employees or 50 full-time equivalents. And a full-time employee is someone employed at an average of 30 hours a week. Okay, that's based on 130 hours of service in a calendar month. So 30 hours a week. If you got somebody working 30 hours a week, they're considered full-time employees. This is exactly why Darden Restaurants was talking about cutting their servers, their full-time people that are working 40 hours to 28 hours because they can't afford to pay this tax. If they're paying that, if they're having to pay that cost of that health insurance, the cost of your meal is going to go up about 40%, or who knows how much. So you got to calculate full-time employees and add that number of full-time equivalents and add it to the actual full-time employees. For given calendar month, total hours of service for all part-time employees, then you divide by 120. And you got to take into account and give them credit for any of these items that are in the policies that you cover. So here's an example. Rainbow Inc. has a workforce comprised of 30 people who work 40 hours a week. They're full-time. Another 80 people who average 20 hours per week. Assuming the part-timers work 20 hours for 4 weeks in that month, you got 80 people times the 20 hours times the 4 weeks, that's 6,400 hours. And that's the key. They do everything off the hours. Divided by the 120, that's part of the formula, you have 53.33 full-time equivalents. And you round down. So 53 full-time equivalents plus the 30 full-time. Up here, you got 83 full-time employees. You're considered a large employer. You have to provide health insurance. You fall into that category. Now, you don't have to provide health insurance for all those part-time people. You got to provide it for your full-time people. And you get to exclude the first third. And I got an example of that, how that would work as well. Okay, applicable large employers. Business must pay a penalty if you fail to offer at least 95% of your full-time employees and their eligible dependents the opportunity to roll in a group plan. Okay? So if you fail to offer that, that's considered a no coverage penalty. Or there's a coverage penalty. Business offers at least 95%. Now you're offering it, but it's considered either unaffordable, it exceeds that 9.5% that we were talking about, or it fails to provide a minimum value. And one of the full-time employees is certified to the business as having received premium assistance credit. You can go out, individuals can go out on these people that signed up for these $8 million people, or 8 million people that have signed up. They can actually get premium assistance credit from the government depending on how much they make. And it's up to 400% of the poverty level. So a family of 4 can earn up to about $90,000, $94,000 and still get a premium assistance credit. So if one of those guys is out getting a credit and you don't offer this coverage, then you're subject to the penalty. And these penalties, of course, are not deductible. All right, so here's an example. Chinook fails to offer minimum essential coverage. Has 100 full-time employees, 10 of whom are receiving the credit for enrolling in the state plan. For each employee over the 30 employee threshold, the company is $2,000 for the year. Now the 30 is, I don't know where they got that from, but that's built into the code. And so you'll see an example what makes sense. So I've got 100 full-time employees. I get to reduce the first 30. So 70 full-time employees times 2,000 is $140,000 penalty. Non-deductible penalty, and it's assessed and you pay it on a monthly basis. I mean, you're talking administrative nightmare to keep up with this. These large employers, all your Fortune 500 companies, this type of stuff, they got their hands full doing this. Inadequate or unaffordable insurance. This is the coverage penalty. Unaffordable, what we talked about was the 9.5% of what you pay them. Or the coverage is if it doesn't cover at least 60% of the medical charges that you're getting. So there's actually set up, the insurance industry has set up these plans, and they're like platinum, gold, silver, and bronze. And as long as you buy one of those plans, bronze is a 60% coverage. As long as you buy a plan that falls into that, then you'll not fall into this trap for the penalty. I also mentioned this covers seasonal employees too. When you go to those full-time equivalents, but the seasonal employees, you can exclude them if they work 4 months or less. If they're working more than 5 months, you can't exclude them from the calculation.
Which really affects an awful lot of us.
Well, that's why I mentioned that. Okay, your minimum essential coverage is supposed to cover all this stuff. So, it's minimum essential represents the coverage is potentially misleading in that it refers to the source of the coverage rather than content. Large employer offering minimum essential could still be penalized, if just one employee gets that premium credit. And again, here's the key. So just a couple of times, if employees share a premium cost more than 9.5% of household income, not considered affordable.
So Steve, it can change. I mean, they wouldn't be affected by this year maybe, but next year if someone does get that. So it's something that just because it doesn't affect you this year, it doesn't mean it won't affect you next year. That's why planning and staying on top of this is really, really key.
You're constantly looking at the quarter that just passed to see where the employees and hours and this type of stuff, particularly with the full-time equivalents, and to see if you got to extend the coverage in the next quarter. Because again, the taxes are assessed monthly.
But the only time you're penalized is when they go and sign up for an exchange or something, or that they hit the radar because I'm an employee. I wasn't receiving coverage, so I went to one of the state exchanges, and now I get the radar, and now
That's right.
the company. But what if they don't go and sign up?
It's roll of the dice there, I guess. You as an employer, you're okay, but you can't control that situation.
Right. I was thinking more on the seasonal guys. A lot of those probably won't go and sign up.
Probably not. I agree. Okay, again, this is just talking about the, I'm going to speed it up a little bit here.
Yeah, we'll wrap it up.
Again, minimum values measure comprehensiveness, has nothing to do with paying premiums. Again, minimum value pay at least 60% of the total benefits under the plan. Okay. Again, same thing, 60%. Let's put this together. This is all brand new stuff, so just sort of highlighting this stuff. The same stuff at 60%. Okay. You can avoid a penalty again as long as they don't exceed that 9.5%. Again, if you got less than 50 full-time employees, not subject to the tax issue. So, more.
So, I have a question for you.
Yeah.
The guy that goes and signs up for it, when he files his taxes, he's going to have to pay the penalty because he doesn't have health insurance.
If you didn't, that's right.
So can they then come back to the employer because you didn't tell them about it?
No, that's an option that the individual has.
Because we have to give the memo so the full health care is not available.
If you have a plan, sure, you can't exclude them. You got to tell them that it's there. And then, if assuming you're offering it to them.
Right. What if you're rolling the dice, assuming they're not going to go and sign up?
Yeah. Well, no, it won't come. In that case, it's not coming back to you, and he's going to be subject to penalty.
But it's still, I don't know that they know what the administration of this is going to be like, because, if he does pay a penalty on his 1040 and they find out you haven't offered it, if they're, I don't know.
I'm just thinking if the IRS said,
Yeah.
called and said, hey, did your employer offer it to you?
I don't anticipate that, but, this is breaking new ground here.
No, I'm just trying to think of dealing with migrant work or migrant
Yeah.
laborers. How in the world are we going
I
to
don't-
get through this? And how are we going to figure out what our costs are going to be?
Where are you exposed? Yeah, where's your risk? Where are you
And
exposed?
what if they don't come back to work for me again next year? They worked for me this year, we didn't offer it. They don't ever come back again.
No, I think you have no liability at that point. I think in your case, you have no liability either. They choose not to get the health insurance, they
You
don't
mean
have
if
the
you
health
offer
insurance.
it? You mean if you offer it and you have no liability?
Even if you don't offer it.
Explain that a little bit.
But if they didn't go get it, and they didn't get the premium assistance credit, then I don't think you're subject to the penalty. Now I think the IRS is coming back at you in that scenario.
Rowdy?
Who in the government is going to be charged with overseeing this ACA? Do they hire a whole bureaucracy?
Well, it was Kathleen Sebelius, stepped down 2 weeks ago.
But is it gonna be Health and Human Services, the IRS?
IRS is, all this tax is assessed through your 1040. Yeah, so it is gonna be through the Treasury Department. So, just so you know, premiums are based on age, where you live, number of family members, and tobacco use. So companies now can charge up 50% additional premium to smokers. Okay, and again, here's your essential coverages: ambulatory, emergency, hospital, prescription drugs, pretty much basic in any plan. All right, here's just some observations. Here's some things that we're seeing. We have a disease care system that encourages procedures. You go see the doctor and he goes, I'm not sure what's wrong with you, but let's order this, let's get an MRI, let's do this, across the board.
Which is where your health savings account really helps save you money.
That's what we're having. But what we're seeing is a movement towards managed care. They want the outcome. The insurance companies, the government, they're tired of paying fee for service, throw everything against the wall, do every test and see what sticks type. They want results. As an example, hospitals cannot readmit Medicare patients within 30 days for the same issue and expect to be paid. So the government's been paying on volume, but they're looking for the quality of care now. And you've seen that through all of your healthcare facilities and your hospitals and stuff. That's a move that they're really moving for. This is just interesting stuff. Last year, healthcare spending in the U.S. was $2.67 trillion, or 17% of our GDP. Covers 56 million low-income people, up to 10 million, up from 10 million, up about 10 million, from 5 years ago. Next year, it's expected to add 20 million people to its rolls. So, why is the Medicare tax, why are they sticking all this stuff in here? There's a reason right there. Look at all the people all the baby boomers are retiring and they're going on into the system. So, and this is what I just mentioned, that you are seeing employers. I've got a company that has 4 restaurants, and because of the ownership, you got to combine all the employees for the 4 restaurants, even though they're all separate corporations. So we're well over 50 full-time employees, and probably what's going to happen, these people don't have to go out and get a second job, because he can't work them more than 30 hours and have to pay that health insurance and absorb that premium. Well, your steak is going up $10, or something thereabouts. So I think it's going to have some really negative impact once this starts coming into play. Let me mention this too, and I won't go through the details because I'll just hurry right through it. But there is a healthcare credit for small businesses that if you are offering health insurance for your employees and you have no more than 25 employees and average wages are no more than $50,000, you can get a tax credit. It's a dollar for dollar credit. So if you're not getting that, you need to go back and look and find out why, because we're filing this on a lot of companies right now. Yes.
Is that an internal benefit, or if you're employed through a leasing company? You're qualified for leasing.
Yeah, you can't. Yeah.
As long as you're providing the health insurance.
Yeah, as long as you're providing.
What do you mean by providing? Do you mean paying for it,
Paying
or
for it,
offering it?
No, paying for it. No, you can.
Based on what
You don't
you
get a
pay
credit for
for.
offering it. You gotta be spending some money. But a lot of our small companies, we're still offering health insurance to their employees. A lot of them have employees that are there 5 years, 6 years, 10 years, whatever, and they offer benefits for them, not for the whole family. But
Yeah,
as long as
especially as competitive as it is today in business, the better companies tend to offer healthcare to attract and retain key employees. So this is something that's often missed, that you can actually get a healthcare credit.
a lot of small companies are missing this credit, and it's there, and it's free money. So go back and look and see if you've been paying health insurance as an employer. Go back for the last 2 years and see, and you can bend those returns and get that money.
Yes, so that's a key point. You can go back and amend up to 2 years, correct?
Mhm. So I won't go through the specifics how it works. I just want you to be aware of it, that it's there. I'll just jump real quick to the individual penalties, and we're just about done.
Let's don't end on a downer. This has been exciting enough.
Yeah, I know. But as an individual, you can't pay a penalty. 2014, it's the greater of 1% of your applicable income or $95. And that's pretty low. So a lot of the younger people who they need in the system to get those monies in the system so that they can subsidize the older people. Well, the younger people aren't doing it. They say, I paid the $95. I'm healthy. I'm not worried about it. I'm invincible at 20 years old. So just a quick example. Here, Dennis and Susan, $125,000 household income. Their threshold for married filing joint is $19,500. That's built into the code. Applicable income is $105,000, so it's $125,000 less than $19,500. The penalty is $1,055 for this joint couple not to carry health insurance. It's the greater of $95 per person times 2, $190, or 1% of your applicable income. So that's how it works. And everything's indexed. It changes. 2015 will be different. 2016 will be different. 2017 moving forward will be different. Let's give you one more quick example. We jumped to 2016. Single no dependents. 2016 has no insurance. Household income is $120,000, and filing threshold is $12,000. Again, that's built into the code. National average bronze claim premium is $5,000. So the black dollar amount cannot exceed 3 times. This is built into the code. It can't exceed that. Percentage of income is 120 less than 12 times 2.5%. That's what goes from 1% to 2.5%, 2,700. So it's a greater of 695 and 2,700. It cannot be more than the cost of getting the insurance itself, which it says national bronze claim premium is $5,000. So the penalty can never exceed what it would cost us if I had bought the insurance. But $2,700 penalty for not buying the insurance. But again, it goes taxed through your 1040. When you file your tax return, all this information, there's going to be a bunch of new lines on your tax return when this starts kicking in. So, and again, as premium assistance, I mentioned it, you can get it up to 400% of the poverty level. Here's your poverty levels. If you have a family size of 4, that's the poverty level, $23,550. You can get premium assistance credit all the way up until your income equals or exceeds $94,200. There would be a lot of families of 4 that would be in this range. So if they sign up for the national plans, those premiums are supposed to run 8 to 9% of your income. With the premium assistance credit, they're expecting it could drop down to around 4%. So it's about 50% savings.
You got to be really careful with those two. When I actually went through that process, I didn't end up choosing to do it, but he asked me what I was going to make the next year, and obviously with self-employed people, you all know, it just varies so much. And when I gave him the estimate, I said, but I don't know what will happen if it changes. He said, if you get a credit based on this income, and your income goes up, you'll have to pay it back. So you have to be so careful, because if you base it too high or too low, then whatever credit you get is your, so you got to be real careful with that.
Yeah, and these penalties are calculated by the month, so it's going to complicate your returns too. So if you go the last 2 months of the year, hey, I got health insurance, I don't have to pay the penalty. No, wrong. You got to pay the penalty for the first 10 months, prorated amount. So, anyway, I think we've really hit the highlights on that.
Any questions on any of this or anything? I mean, it's amazingly complicated, isn't it? I mean, it's complex and complicated. There's so many variables, if this, then that. You know, it's just crazy. How much is wrapped into this plan with the ACA. So, you know, again, you you've heard me say it before, but I'll say it again, you know, it's all about planning. So, you know, you have your wealth advisor like Eric and I, and then you have your tax advisor like Eric and Steve, and then we try and very much bring in your legal advisor, your attorney. So most entities or folks, they meet with them separately, so something's kind of lost in the translation where the right hand doesn't know what the left hand's doing. So what we try and encourage our folks to do is, you know, at least let your investment guy, your tax guy, meet together with you, and then, you know, from time to time when it's necessary, we can bring in your attorney. But looking at things ahead of time, being proactive as opposed to reactive, and taking the time, and we're all super busy, but take the time, it's worth a couple hours to sit down and say, you know, what changes can I make to save money? What can I do to protect myself from liability? How can I reposition my investment so that I minimize the taxes that are going to affect me? And all these things, you know, really are going to be very beneficial and productive to you and your family. Does that make sense? Any questions? Isn't this exciting stuff? Makes you want to just jump up and turn cartwheels and all? It kind of makes your head spin, doesn't it?
It's reality, it's here. It
Yeah.
looks like it's here to stay.
What we don't want to do is spur you to inaction, right? It's so overwhelming that you say, geez, you start your hands and say, forget it. You know, if you're going to climb a mountain, it starts one step at a time. So maybe you can't address everything at once, but if you'll systematically sit down with your tax advisor and your investment advisor and make it a team thing between your company, your family, your spouse, whatever, you know, you can get your arms around all this and really minimize the cost and the impact. So there's no